Hello and welcome to Dr. Chris's Key to the Manager's Mindset. Today, we're embarking on an exciting journey, one that holds the key to understanding and mastering your personal finances. Our topic of discussion, inflation. Yes, that mysterious economic phenomenon that quietly affects your buying power. Inflation may seem complex, but with a little bit of guidance, it can be understood, managed, and even utilized to your advantage. Over the next several scenes, we'll be demystifying inflation, exploring its impact on everyday expenses, savings and investments, and most importantly, sharing strategies to protect your hard-earned money against it. So, are you ready to unlock the secrets of inflation and take control of your financial future? Let's dive in. Imagine you've saved up $100 and you're feeling pretty good about it. But what if I told you that same $100 might not buy you as much next year or the year after? That's the power of inflation. Yes, the invisible force that's constantly at work, quietly eroding the value of your hard-earned money. But don't worry, it's not all doom and gloom. In fact, understanding inflation can be a game changer for your personal finance strategy. It can help you plan better, invest smarter, and ensure your financial stability, even in the face of rising prices. Over the next 20 minutes, we'll be unraveling the mystery of inflation, exploring how it's measured, its impact on everyday expenses, savings, and investments, and most importantly, how to protect your finances against it. Ready to delve into the world of inflation? Buckle up and let's get started. Inflation, in simple terms, is the rate at which the general level of prices for goods and services rises. Let's break it down. Imagine you're at your favorite coffee shop and your go-to latte costs £3. Then inflation kicks in and the price of that latte goes up to £3.30. This increase is inflation at work. But how does this affect you? Well, if your income stays the same, but the prices of the things you buy increase, you're essentially able to buy less with the same amount of money. This is known as a decrease in your purchasing power. Now you might think, it's just a 30p increase, how much difference can it make? But let's cast the net wider. Consider all the goods and services you pay for: food, rent, transportation, healthcare, and so on. If their prices rise and your income doesn't, your budget takes a hit. You're shelling out more pounds for the same items, and you can feel the pinch. Inflation is like that slow leak in a tire. It might not seem like a big deal at first. You don't notice the gradual loss of air. But over time, the tire becomes flatter and flatter. And suddenly you're not cruising anymore, you're struggling. So, when we talk about inflation, we're not just talking about price increases. We're talking about how these increases can affect your ability to maintain your lifestyle. If the cost of living rises faster than your income, you may find yourself having to cut back or find ways to increase your income to keep up. But here's the kicker: not all inflation is bad. Moderate inflation is a sign of a healthy, growing economy. It can stimulate spending and investment, which can lead to job growth. It's when inflation gets too high or happens too fast that it becomes a problem. So, whether you're a student saving for your first car, a family planning for a home, or a retiree living on a fixed income, understanding inflation is crucial. It's an invisible force that can impact your financial well-being. So, inflation can subtly chip away at your money's value over time. But how do we know when inflation is happening? How do we measure it? Well, we use certain indicators to keep track of inflation. The most commonly used measure is the Consumer Price Index, or CPI. The CPI tracks the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. These include everything from a loaf of bread to a haircut, or even a visit to the dentist. Changes in the CPI are used to assess price changes associated with the cost of living. Now, let's consider the Producer Price Index, or PPI. While the CPI measures the average change in prices from the consumer's perspective, the PPI does so from the seller's perspective. It measures the average change over time in the selling prices received by domestic producers for their output. A rise in the PPI can often signal that a rise in the CPI, and therefore inflation, is on the horizon. Finally, we have the Personal Consumption Expenditures, or PCE. The PCE measures the changes in prices of consumer goods and services. This includes durable goods like cars, non-durable goods like groceries, and services like healthcare. The PCE is unique because it adjusts for changes in consumer behavior, So if the price of beef goes up and people start buying more chicken instead, the PCE takes that into account. All these indicators work together to give us a comprehensive view of inflation. Each of them has their strengths and limitations, but together, they provide a pretty clear picture of what is happening to prices in the economy. Remember, inflation isn't just a number or a statistic. It's a force that can erode the value of your hard-earned money over time. That's why it's so important to stay informed and understand how inflation is measured. These indicators help us keep a pulse on inflation, so we know exactly when our money's purchasing power is at risk. Inflation doesn't just exist in economic textbooks, it hits right where it hurts, our daily lives. Imagine this. You start the year with a certain budget for your groceries. You've figured out how much you need to spend on your fruits, vegetables, dairy, and grains. But as the months roll by, you notice that your grocery bill is creeping up. The price of apples has gone from $1 a pound to $1.20. Milk, which used to cost $2 a gallon, now costs $2.50. And this is not because you're buying more, but because the prices of these items are increasing. This, my friends, is inflation in action. Let's take another example. Housing. Whether you're renting or paying off a mortgage, housing is a significant part of your monthly expenses. Now, inflation can push up the cost of housing over time. Landlords may increase rent to keep up with rising costs, or property values may rise, leading to higher mortgage payments. You might find that the apartment you could comfortably afford last year is now stretching your budget thin. Then there's transportation, another unavoidable expense for most of us. Whether you own a car or use public transportation, costs tend to rise over time. Fuel prices, maintenance costs, and public transport fares are all subject to inflation. One day, you're paying $3 for a gallon of gas, and the next, it's $3.50. And it's not just these big-ticket items. Inflation impacts the cost of everything from your morning cup of coffee to your gym membership. Over time, these small increments can add up, leaving less money in your pocket for savings or discretionary spending. Now, you might be thinking, but my wages are increasing too, so it's not a problem, right? Well, not quite. While wages do generally rise over time, they don't always keep pace with inflation. If the cost of living is increasing faster than your wages, you're effectively earning less than you were before. Moreover, inflation doesn't always affect all goods and services equally. Some prices might skyrocket while others stay relatively stable. This disparity can lead to changes in consumer behavior. As prices rise, people might cut back on certain goods or services, or switch to cheaper alternatives. This is known as inflation-induced substitution. Lastly, let's not forget that inflation also impacts your savings. If you're saving money for a future goal, like buying a house or retirement, rising prices mean that your saved money will buy less in the future, so inflation can erode the purchasing power of your savings over time. In conclusion, inflation is like a slow leak in your wallet, gradually draining your purchasing power. It's an often overlooked factor that can make a significant difference in your standard of living over time. Inflation can make a significant difference in your standard of living over time. Inflation doesn't only affect your daily expenses, but it also erodes the real value of your savings and investments over time. Imagine you've saved £100 in a piggy bank. A year later, due to inflation, the cost of goods and services has risen by 2%. Now the purchasing power of your £100 has effectively diminished. Even though you still have the same amount of money, you can't buy as much with it. This is how inflation erodes the real value of savings. When it comes to investments, inflation can be a double-edged sword. On one hand, some investments, like bonds, can lose value in an inflationary environment. Bonds are essentially loans you give to the government or a corporation. In return, they promise to pay you a fixed amount of interest over a set period. However, if inflation is higher than the interest rate, the money you get back will have less purchasing power than what you initially invested. Therefore, you'd be losing money in real terms. On the other hand, investments like stocks and real estate can potentially offer some level of protection against inflation. Stocks represent ownership in a company. If a company can pass on higher costs to customers in the form of increased prices, it may maintain or even increase its profits during times of inflation. Therefore, the value of its stock may rise. But remember, Investing in stocks comes with its own set of risks, and there's no guarantee of returns. Real estate is another asset that tends to hold up well under inflation. As the cost of materials and labor rises, so does the cost of building new homes, pushing up the value of existing homes. Additionally, landlords can increase rents over time, providing an income that keeps pace with inflation. However, real estate also comes with its own set of challenges, such as property taxes, maintenance costs, and potential difficulty in selling the property. So, what does this all mean for you? Well, it's crucial to factor in inflation when planning your savings and investment strategies. Just leaving your money in a savings account or under the mattress might seem safe, but in reality, your money is gradually losing value due to inflation. When it comes to investing, consider diversifying your portfolio to include a mix of assets. Some, like bonds, may offer stability, while others, like stocks and real estate, may offer growth potential and some degree of inflation protection. But always remember, all investments carry risks, and it's important to do your research or consult with a financial advisor before making investment decisions. Furthermore, consider the impact of inflation on your long-term financial goals. For example, if you're saving for retirement, consider that the cost of living will likely be much higher in the future due to inflation. Therefore, you'll need to save and invest even more to maintain your desired lifestyle in retirement. In conclusion, while inflation is often seen as a villain in the world of personal finance, understanding its effects on your savings and investments can help you make better financial decisions. After all, knowledge is power. So, inflation can be a silent enemy to your financial growth if not taken into account. Now that we understand the effects of inflation, the question is, how can we protect our finances from it? Firstly, let's consider the creation of an inflation-proof budget. It's crucial to understand that as inflation rises, the cost of living increases. To keep up, your income should ideally rise at the same rate. But if that's not the case, adjusting your budget to account for these changes becomes necessary. This might mean cutting back on non-essential expenses or finding ways to increase your income. However, budgeting is just the first step. Ultimately, the goal is to grow your wealth faster than inflation can erode it. This is where investing comes in. When it comes to inflation-resistant assets, Treasury inflation-protected securities, or TIPS, are a noteworthy option. These are government-issued bonds indexed to inflation. As the inflation rate rises, so does the value of TIPS. This makes them a reliable choice for safeguarding your money against the erosive power of inflation. Next on the list is real estate. Properties often appreciate in value over time, generally keeping pace with or exceeding the rate of inflation. Moreover, if you rent out your property, you can adjust the rent periodically to account for inflation, providing a steady source of income. Then there are commodities like gold and oil. Their prices often rise with inflation, making them a potential hedge. However, investing in commodities can be complex and risky, so it's not for everyone. Equities or stocks are another inflation-resistant asset. Companies can adjust their prices to account for inflation, which can lead to increased profits and subsequently higher stock prices. However, stocks can be volatile and carry their own set of risks. This brings us to the importance of diversification. By spreading your investments across a variety of asset types, you can buffer your portfolio from the impacts of inflation. If one asset class performs poorly, others may perform well, balancing out your returns. Lastly, let's touch on retirement planning. Inflation can significantly impact your retirement savings. $1 today might not have the same purchasing power in 20, 30 years. Therefore, it's essential to factor in inflation when calculating how much you need to save for retirement. Consider investment options that offer potential growth above the rate of inflation. In conclusion, while inflation is an unavoidable economic phenomenon, it doesn't have to spell disaster for your personal finances. By adapting your budget, investing wisely, diversifying your portfolio, and planning for retirement with inflation in mind, you can safeguard your financial future. Armed with these strategies, you can take charge of your financial future, no matter what inflation throws your way. For those of you interested in digging deeper, let's talk about hyperinflation and the role of monetary policy. Hyperinflation is like inflation on steroids. It's when the price of goods and services skyrocket at an extremely rapid pace, usually more than 50% per month. This isn't just a theoretical concept, it's happened in history, in places like Zimbabwe and Venezuela. Hyperinflation can have devastating effects on personal finance. Savings can become worthless almost overnight. Imagine waking up to find that the money you've saved for years can barely buy a loaf of bread. It's a bit of a nightmare scenario, right? But don't worry too much. Hyperinflation is relatively rare, and most countries have safeguards in place to prevent it. One of these safeguards is monetary policy, which brings us to our next point. Monetary policy is the process by which the central bank or monetary authority of a country controls the supply of money, often targeting an inflation rate or interest rate to ensure price stability and general trust in the currency. In simpler terms, it's how the big financial institutions try to keep inflation under control. They do this by adjusting interest rates and buying or selling government bonds. When they raise interest rates, it becomes more expensive to borrow money, which slows down spending and helps to keep prices stable. Conversely, when they lower interest rates, it becomes cheaper to borrow money, which can stimulate spending and potentially lead to higher prices. But monetary policy isn't just about controlling inflation. It also plays a crucial role in maintaining economic stability and fostering healthy economic growth. It's a bit of a balancing act, and it's not always easy to get right. But when done effectively, it can help to prevent the kind of runaway inflation that can wreak havoc on personal finances. These advanced concepts give us a wider perspective on inflation and its potential impacts. Understanding them can help us to better navigate the financial landscape and make more informed decisions about our money. So we've taken a journey through the world of inflation, and it's clear that understanding it is key to personal financial planning. We've delved into the intricacies of inflation, from its definition to how it's measured, and we've explored its impact on everyday expenses, savings, and investments. We've seen how inflation can erode the value of our savings over time, and how it can affect the cost of living, from the food we eat to the homes we live in. We've discussed strategies to protect personal finances against inflation, from creating an inflation-proof budget to investing in inflation-resistant assets and diversifying our investment portfolios. Moreover, we have underlined the significance of considering inflation when planning for retirement. It's crucial to stay informed about economic trends and adjust personal finance strategies accordingly. Remember, knowledge is power, especially when it comes to protecting your money. Thank you for joining today's exploration of inflation and its impact on personal finance. If you found this video enlightening and seek more financial wisdom, don't hesitate to hit that subscribe button. We'd love to hear your thoughts too. Got any experiences or tips on managing inflation? We're all ears. Drop them in the comment section below. Let's keep the conversation going. Until next time, keep an eye on your money and stay financially savvy.